Howdy, Jacob here. Today we're looking at Aecom in the construction engineering industry. 12.8 billion market cap on a 13.7 billion enterprise value. They provide professional infrastructure consulting services worldwide. They operate through their three segments: Americas, International, and then their Aecom Capital. Their growth is actually down from 2015. There was huge growth between 2014 and 2015, but after that, you're really looking at negative 1 to 2% a year in revenue growth. Pretty poor returns on invested capital. Their earnings per share is nothing to brag home about, with a margin that's 5% on the operating side and 6% on the growth side. So we're looking at very poor margins here. You're definitely going to want to buy this company cheap. And their share price, they have been reducing earnings per share substantially since 2016. So there is that. I guess 2020 was really when they started refocusing on it. So the last 3 years, really putting a lot of money. They're repurchasing shares. Let's look at that balance sheet quick. So 1.2 billion cash on hand, 89 million due in short-term debt, and then 2.1 billion in long-term debt. They did issue quite a bit of debt in 2015. Maybe they purchased a company, maybe they went into debt to make an acquisition. But they have been reducing that pretty substantially over the last 7-8 years. So they are focusing on it, which is a positive. The use of cash flow in the last 5 years, you're looking at probably about $600-500 million in free cash flow. Majority of it is definitely going towards share repurchases. Their dividend paying out $100 million is about a 20% payout, and then their debt is a little bit as well. Acquisitions pretty minor, so majority share repurchases, and then a little bit of reinvestment, acquisition, debt pay down, dividend payout, and I think ready to make some assumptions here on the revenue growth side. Man, we could be looking at a flat business. Let's try 0 and 10%, or 0% revenue growth, 10, saying that maybe it just stays here for essentially ever. I could see them having possibility of growth, maybe through a little bit of acquisitions and reinvestment, but really not much. So I'm going to be conservative and say that that's pretty flat. Their stock price here, 1% would be about 130 million, 2% would be about 260 million. So with their stock-based compensation, 2% would be about 300 million in aggregate payout, which is about 60% of their cash flow. But they've historically, at least the last 3 years, done that. So I'm pretty comfortable saying they're going to buy back 2% of shares. And their margins are very low. Free cash flow is a lot higher, so I do appreciate that. I do appreciate pretty heavily that the free cash flow is quite a bit higher than their net income. So maybe let's do 4 and 3%. Their dividend is currently paying out 20%. They could probably increase that a little bit, but they haven't been doing it long, so I'll probably just say no growth, since I'm assuming no revenue growth here. And it is nowhere near stupendously cheap to where I'm going to want to buy this. I'm going to want to buy this company very freaking cheap, and it's just not there. So pretty short video, but I do hope you enjoyed it and have a great rest of your day. Thank you.